These are my top 3 tips you should know before you even place a trade. Number 1, you need to make sure you're aware of your bias, right? And what I would say is you want to make sure you understand why you justify being a buyer or seller in the first place. Now, you can break it down in a number of tools. You can use seasonality data to get an awareness of where you are during that period of the year. So, for example, the British pound does very well during the month of April. So, let's say we're trading around April time, and we have that awareness that the pound does very well during this period of time. That's one tool we can use to justify that particular bias, to be a pound buyer during that period of time. Another tool I like to use is what's called commitment of traders report. So that's actually starting to see what the market makers are actually starting to do. Are we actually starting to see the commercial side? Now, you've got to remember, the markets are made for business to business transactions. So are we actually starting to see commercials? These are your JP Morgans, your Goldman Sachs. So they actually start to buy British pounds. If we see that they are actually starting to buy it, reinforced by that seasonal bias that we are very strong in the month of April with that seasonal technical tool, we can then say, right, we are now looking to be a pound buyer. Of course, there's other technical tools as well. We can use pivots, for example, if price is coming off a nice pivot point to use. So, look, there's a number of tools you can use to justify your bias, but what you need to make sure you do, again, before you even press buy or sell, is understand why you're looking to be a buyer or seller. When it comes back to reflection, let's say natural reality that you wanted to be a buyer, but let's say the market did the complete opposite of what it is you actually wanted price to do. What you can then do is back in reflection actually see, right, what can you then improve, or what you need to then focus on so that mistake doesn't happen again. So it's now you're not only starting to look at tools to help you understand what price may do moving forward, but you're now starting to improve on how you're actually going to start looking at justifying your trades. So that's the first thing to make sure, like I said, be aware of why you're looking to be a buyer or seller in the first place. So having that clear bias is very important. The second thing you then need to move on to is the justification for the entry, right? Now, what I like to say with the entry, right, what your strategy rules are. Well, first, let's highlight what they're not, right? Number 1, it doesn't tell you what market to trade. It doesn't tell you the timing, if it's the correct time or not to get in the trade. It doesn't tell you the area of the market you should get. It just tells you very simply what to look for. You may have what you need to look for to place buy or sell, but like I said, it doesn't tell you, the strategy won't tell you if this is the correct timing, if this is the correct area of the chart. For example, let's say you're in a market range, and in between the range, you have your entry rules that meet your rules to buy. If you're a trend-based trader, well, straight away, if you're in a range, even though it meets your rules to buy, you understand you're in that range, so you shouldn't take that buy trade in the first place. And the point there being, although it meets your rules, because technically it's not in the right area in which you want to be a buyer or seller in, you shouldn't take that trade. So moving forward, when you take a buy, when you take a position, it needs to meet the strategy rules. And again, you might find that it meets all your rules to place a buy or sell trade. But if it's not in the right area, then we can then say, what are the solutions we need to focus on so we don't reoccur, this problem doesn't become a reoccurring problem. So first one is obviously having that bias, making sure you know why you're a buyer or seller, having that clear-cut understanding to justify that. The second one is obviously your entry rules, making sure you know why you place the buy and sell trade. And again, you can then improve by adding different tools to it, pivot points, limit orders, buying off pivots, selling off pivots, whatever it may be. So that's the second step. And the third step, I would say, the last one is the justification for the management of the position, right? I like to use this illustration a lot. Let's say, for example, you're in an uptrend, right? Let's say you have 2 positions. Let's say the first position is at the very start of that movement, and the second position is at the very end of that movement. Now, if the question is, what is the best management style to use? Well, it depends on where you are, right? For example, if the management style is you want to have a longer term approach, and you had the 2 options, number 1 at the start of the move, number 2 at the end of the move, and the question is, which management style would you associate a longer term view on? Well, it's going to naturally be number 1, right? And again, it's not because we chose to or we felt like doing it, it's because of where we are in the charts, right? So based on the bias that you make, you understand where you are on the charts, that will then associate what management style you need to be using for that trade, right? if I'm 5 days, 6, 7 days in a buying move and I take a trade that meets all my rules and I say, right, I'm gonna let the trade run, and the market then turns around on me, well, no surprise, because we're so high up, right? So we need to make sure that we're well aware of where we are and where we are trading before we place that trade. So we understand that, right, if I'm going to take this trade, I know straight away this is going to be more aggressive management style. Or if I'm in this trade and I know where I am and very low down, there's a very high likelihood the market may continue to go to the upside. Well, that we have a long-term view. So just to summarize very simply on the management point, we need to make sure we associate the right management style to the trade in which we're taking, right? If we're taking the trade and it's very choppy, market sentiment is a bit mixed, and it's very much momentum-based trade, and you place that trade, well, you need to be very much on top of it, right? If the momentum starts to change, if the sentiment goes from mixed to on, then, we need to make sure we're aware of these things and take action. So I would say, to summarize the question, to summarize what we discussed, summarize that point of what are the three main things you need to be aware of when placing your trades. Number one is you need to make sure you know why you're buying or selling. Is it the right thing to do? Number two, does it meet your buying or selling strategy rules? And number three, what is the management style for this trade you take? Once you have a very good comprehensive understanding of all those three things, and you place that trade, you should feel very confident, right? And look, trading is very simply, as a trader, you're very much a decision maker, right? So you've got to make sure every decision you're making, whether it be placing that position, moving your stop loss, and then take profit, every single decision you make needs to have a technical reason behind it. And like I said, if you're able to document, if you're able to understand why you're making these decisions and they go against you, we can then prove this in reflection. Hopefully that makes sense. Any questions, obviously get in touch.